afternoon, ladies and gentlemen, again. And thank you very much for joining us this afternoon. From our side, we're certainly hoping that this will be our last online investment conference. We certainly prefer the in-person format where we can socialize, catch up with people, see who's lost weight, who's gained, and generally see how people are doing. I think we prefer that level of interaction with our clients. We're quite excited at the agenda that we have for this year. I'm going to be 5 to 10 minutes with my presentation. I think given everything that's happened this year, I think the issue of energy security and what that potentially looks like for South Africa is quite a big topic. So we're quite excited to have Desson Woodley, the Managing Director of Global X South Africa, present to us and give us some insights around that particular issue. One of our milestones for this year as a business, but certainly from a personal perspective for Wynand, our advisor based down in Cape Town. He published a book titled To 100 and Beyond, just talking about the issue of longevity and what that means from a financial planning perspective. So we've asked Wynand to speak to that. And then our sort of keynote speaker for this year's conference is Dan Brockelbank, who's the head of Orbis UK. Orbis is the Allan Gray Offshore or International Asset Manager. They're based in the UK and in Bermuda. And Dan heads up the UK office. And I won't do an introduction now, but I'm really looking forward to the presentation, having seen it. I think it was just last month. So that's the presentation for the conference. But before we go in there, I'd just like to, as we traditionally do in our investment conferences, is give our clients an update on the business and how GMI is doing. I think suffice to say that the business continues to grow from strength to strength. We continue to attract new talent into the business and new clients. A decision we took several years ago, was to bulk the team up from the back office to the front office. Typically, firms like ours tend to get more advisors, more front office people. And then the back office tends to break down, and then they bring in the back office. We felt that we needed to get the service team working and big enough and capacitated, and that gave us the confidence to bring in more advisors. From a growth perspective, the Cape Town office continues to grow. So there were 3 staff last year this time when we had the last conference. It's now grown to 5 staff, and we continue to interview more people for the Cape Town office. We've reopened Durban. Some of you may recall that during COVID we had to shut the office down. That was one of the steps that we took to sort of ready the business for the potential impact of COVID. And now we have the confidence to reopen Durban, and we're quite excited. We have 3 staff in that office, and again we continue to look for more people. The short-term insurance business continues to grow, looking for more people in that business, but with the team that we have, again, our approach of being an independent advisory business is paying off there. So the team was able to source quotes from across the industry and see where our clients can get the most competitive rates and the best cover. So that continues to grow as a business. And then, as some of you may recall, we started our fiduciary services business last year. In that business is where we draft wills, where we structure or put together trusts and register trusts, business and family trusts. And to date, we've done over 200 wills for our clients in just less than 2 years. And if I can use the opportunity, I think it's worthwhile. If you do not have a will, it is most certainly the most important document you could draft, and it's, I would say, the foundation of financial planning. It's one of those things, together with the budget, where a will is really important in terms of ensuring that assets go where you need them to go, excuse me, and to make sure that you do not pay more tax than you need to pay. So we would encourage you, if you do not have a will, or if you haven't reviewed your will in a long time, to certainly do that. And then finally, in terms of the bigger investment business, we've grown assets. It's been a difficult environment in which to do this, but we've still managed to achieve some growth in the general business and also within the GM funds that we manage for clients. So I would like to speak on two issues very quickly, and I've literally have 2 slides on both these issues. I think very topical issues. On the issue of investing offshore in 2022, we sent out a client note yesterday, and we will be sending a corrected or updated note this afternoon, if you haven't already received it. There was just one of the graphs interfered with the subsequent paragraph, so one of the sentences was cut off there. But just from an investing perspective, or just from our perspective, when it comes to investing offshore, we see a lot of people are struggling with the issue of the weak rand. So you see the rand started the year at 15.90 rand to the US dollar. It's currently at around 18.34, although when I went on to have a look earlier, it was sitting at 18 rand to the dollar. So it's strengthened in the last day or two. But the impact of that, and I think this is what people know intuitively, is that your 1 million rand discretionary allowance buys you a lot fewer dollars than it did this time last year or at the beginning of the year. So at 15.90 per dollar, your 1 million rand will buy you $62,900. And today at 18.34 rand, you're getting roughly $54,500 for your million rand allowance. And a lot of people are caught on this, saying, well, is it a bad time to take money offshore? I'm getting fewer dollars for my rands. But I think it's important that people also note the fact that markets globally, not only in the US, the markets are down, and they're down anywhere between 20 and 30%. Asset prices in general. So if you look at US property, residential property, some areas down as much as 35%. So when you start to factor that in, and when we look at a fund like the Ned Group Core Global Fund, which is a fund that we use a lot for offshore clients, it's a passive fund. It's invested in equities, bonds, property, cash across the globe. And when you look at a fund like that, which makes a very good core holding in a client portfolio, what you realize is that even though you are getting fewer dollars for your rands, you are able with those dollars to buy more units in a fund like the Ned Group Core Global, and in fact, many other funds that we invest clients' portfolios in. So you see there that you're getting almost, 12-13% more units, despite the fact that you got 15% fewer dollars. And the same would apply if you were to go and buy a property in the US. Because property prices are down significantly, the fact that you're getting fewer dollars is not translating into you being able to buy fewer assets. In fact, it's the opposite. And bear in mind that your unit price increases when markets recover, and markets go through cycles. I'm not going to talk about that now, but this will pass. Inflation will roll over, and we'll see markets going back up again. But this is what the picture looks like. So, yes, I can see the graph. So the blue line is the Net Group Core Global since inception, and the red line is the average global balance fund. And these are dollar performances. So you can see it's a good fund. These funds tend to move in lockstep, but the lower cost of the Core Global, and it's a very well-structured fund. You, as a result, got a good return relative to the average, the sector average. And you'll see there that since the start of January, with global markets coming off, Russia, oil prices, Chinese COVID policies, various reasons that markets have come down, global inflation, rising in the US, and global interest rates have all contributed to the drop in the market. But with the fewer dollars that you're getting for your money, for your rands, you're actually going to get more market exposure. I think very important that we remember that. And then the other trend that we're seeing, and we'll be putting out a client note next week, is that investors are getting much better interest rates this year, certainly compared to last year, as a result of interest rates going up. And a lot of our clients are sitting with money in the bank, and we're seeing, again, from industry statistics, that bank deposits have increased. I think it's the note that we put out just looks to help you understand the trade-off that you make between liquidity and yield. And what I mean by that is that liquidity simply refers to how long you have to wait before you can get your cash out of an investment. And when it comes to maximizing interest, typically you need to give up liquidity to get a higher yield or to get more interest. So what this looks like is that for a 32-day notice account, for example, pays more than a bank call account. So on a call account, you get like 4% interest, but on a 32-day notice account, you can get 6.5%. Okay, it's because you've given up liquidity. You can only access your cash after 32 days. And therefore, you are compensated by the bank with a higher interest. Again, if you're prepared to give up even more liquidity, so tie your capital for 5 years, so no access to your capital for 5 years, you'll get more than a 32-day call account. So it's navigating that trade-off between liquidity and yield that tends to be the challenge. And I think this is the area where we, as GMI, can add a lot of value to clients. So this is a table that will appear in that document that we'll be sending out next week. And we just did a bit of research into seeing what sort of rates clients can get. And we try to get from across the market, so not pick on any one provider. So you'll see there that a bank call account, which has 24-hour liquidity, FNB, which is one of the bigger banks, pays 4.6%. And you typically wait 24 hours to get access to that. We have a corporate cash facility where we are able to give clients a net of cost yield of 6.16%. So without increasing your liquidity, you can increase your yield quite significantly. The cash facility is offered by 2 of the big 5 banks, And essentially what they've done is they've outsourced some of the administration to GMI. And because of that, they are able to pay clients a higher yield because they do not have to carry the staff costs associated with doing that themselves. In the unit trust space, the more investment risk that you prepare to take on, the higher the yield that you can attract. So a money market fund, which gives you access within 5 working days, currently yielding just north of 6.5%. An income fund, which has some bond exposure, some fairly short-dated bond exposure, that gives you 6.8. Those costs are all net of fees. The Gradidge-Mahura income model, it's a model portfolio investing in high income yielding funds. That's currently has a forward yield of 9.23%. But I think it's important to state here that your income and your enhanced income type funds give you that higher yield because of the bond exposure. However, that bond exposure can mean some capital volatility. So if you see in the next graph, generally very stable for the most part, but that was when COVID hit. You had a bit of a pullback and a fairly quick recovery. The same with income funds. However, as you've gone up the risk spectrum, you've been compensated for that in the form of a higher return. So the income fund over time giving you about 1% per annum better. At the moment, bond yields are very high, so that is why the prospective returns look a lot better. And then there's your 32-day call account. So as you can see here is that if you give up a little bit of return, you can get a lot more liquidity with either a cash manager or a money market solution. You know, it will cost you less than 0.5% on the money market, but you'll be able to access your capital a lot faster. And there's your 5-year fixed deposits. So some of the banks giving fairly good rates. Retail savings bonds continue to be quite attractive as well. Okay, so yeah, I don't want to take up too much of your time, but yeah, GMI continues to grow from strength to strength. We continue to build the team and to look to bring in more services that we can offer to our clients. From an offshore perspective, I think important not to get too hung up on the rand-dollar exchange rate and lose sight of the fact that asset prices are quite weak. So you're fewer dollars buying more assets. And then, yeah, talk to us if you need to leave money in the bank and you need a bit of assistance navigating that trade-off between liquidity and yield and interest. And we can see if we could structure a solution for you that gives you, I would say, maximum yield with optimal access to your cash.